Hey, everybody, welcome back to Grain Markets and Other Stuff. I am joined by a special guest today. We have Ken Morrison on the show. Ken, everything going all right today?
It's going fine. Absolutely.
I'm really happy to have you back. Happy New Year. A couple housekeeping notes here, guys. In the description boxes on both YouTube and on Facebook, if you're watching live, I have the link to Ken's website, which is Morrison on the Markets. If you want to know a little bit more about what he's doing, make sure you check that out. Certainly highly recommended. Aside from that, if you're watching on YouTube, make sure you subscribe. Make sure you hit the like button. For all of these, all those of you listening on the podcast, thank you again for tuning in. We're going to dive right into this here. What's happened here recently is that we've seen a lot of speculative money make its way into the grain markets, and we want to talk to Ken a little bit about that. We want to kind of first identify, I think, what has happened, and then maybe try to answer the question why this has happened, which is maybe a little bit tougher to do. Ken, should we start off with this chart of the U.S. dollar?
Yeah, I think that's a good place to start.
Okay, so we've got a U.S. dollar chart going back to about 2009, and as you can see, we're kind of coming down to those 2018 lows. We're trading some fresh two-year lows here this week. What do you make of what's happened here, like, post COVID America and the currency market?
Well, I think it's undeniable that the influence of the weaker dollar against the major currencies is always a factor in the commodity market. The challenge is always to determine what proportion of the moves in commodities is linked to the weakness in the dollar. But I just kind of leave it with the notion that it's had an effect. I'm not sure it's been the overriding driver. I think, and I say that because you take commodities like oil as an example. Oil is really not done a whole lot, certainly not to the degree that the grains have done. So I think weather has been the overriding domineering factor in the corn and soybean markets, but the dollar has had an influence. I think the thing we tend to lose a little bit of sight of when we focus so much on the strength of the dollar against the major currencies, and let's face it, I mean, the euro is 55% of the dollar index, so that needs to be recognized. But I think the thing we lose a little bit of sight of is that you compare, for example, the commodity market that we saw in 2008, which in my mind, other than going back to the Russian grain deals, is in my mind the most speculative environment that I've ever experienced in commodity markets. The point I'm trying to make is the currencies of our major competitors now, being Brazil and Russia, are significantly weaker against the dollar than they were in 2008. So I think those are the kind of issues that I tend to pay attention to more so than the dollar index.
Yeah, and to go back to 2008, I mean, you look on this chart here where the dollar bottomed in 2008. I mean, the dollar was at 71, 72 in the dollar index. We're still way above that. I mean, we're way above 2008 levels in the value of the dollar. So there may be some parallels there, but not quite necessarily in terms of just the flat price of the US dollar versus these other currencies, I guess.
I agree. Yes.
Okay. So our next, which chart you want to go with next? You want to do one of the commodity charts?
If we talk about the dollar, it's important to also talk about what interest rates are doing, or maybe the better way to say that is, if we're going to talk about a weak dollar, then we're also going to talk about reinflation, which has been a factor and an influence in commodity markets. We need to talk about the yield on treasuries. And certainly you can begin to see the yields on the treasuries are beginning to tick up. Today crossed 1% on the 10-year treasury yield for the first time since March of 2020. And so, there is a theme here, and the theme is there is inflation in the minds of investors, and I think we're also beginning to see, somewhat triggered by the notion that the leadership in the Senate looks like it's going to change as of the end of today. And so with that, the perception is that there's going to be increased COVID relief, and as a result, increased government borrowing. And so we're beginning to see interest rates tick up.
So to go back to the dollar, and I guess this also relates to the yields, but how much of that weak dollar do you think has to do with the stimulus, the money printing, whatever you want to call it, more dollars in circulation? I mean, is that the driving factor behind the weakness in the dollar, you think?
I believe it is. Perception is 80% of reality in markets. And I remember a chart that you actually put up 2 or 3 weeks ago that really got me thinking about this. And I think if I recall, you put up a chart that related the timing of the first stimulus to the weakness in the dollar. And so, absolutely. I mean, nothing said it more clearly than those charts that you had posted 2 or 3 weeks ago.
Yeah, I don't have those in front of me, but basically what I had posted was first a chart of the dollar, and the dollar peaked basically in the same week almost that they passed that first stimulus in March. We saw the commodity markets, and I'll throw this. You want to go to this commodity index chart?
Yeah, that's good.
Okay, so the commodity index, I'll go to find that shorter term one first. The commodity markets as a whole, when tracked by an index, essentially bottomed around the same time that first. It was basically the exact same time almost that
end of April or end of March.
Yep. It was here's the Bloomberg commodity index chart on the screen. So right here, these lows were basically late March, right? The same week that Trump signed that stimulus, essentially.
Right. You had a low in the commodity index in March, and then you had a successful retest, I think, in May, as the chart then shows. And so, absolutely, there's been a correlation there.
And there were some markets, the grain markets have done crazy things, but you got to remember in that time, that was when crude oil traded like negative. There were a lot of things that were under pressure, and we've seen things totally reverse course here. Yeah,
no question about it. The thing I find interesting, however, about and for people that don't know, I should explain that this Bloomberg Commodity Index, there's actually 2 or 3 major commodity indexes. The Bloomberg Commodity Index is my favorite one to use because it's more or less equally weighted among 23 commodities. It's equally weighted among about 5 sectors, and I'll boil it down basically between energy, metals, grains. They are each around 30 to 31% of the weight, and then there's about 8% weight in livestock. And so I prefer this particular commodity index over the old, what they call I call it the Goldman Sachs, I guess it's now called the S&P Goldman Sachs Commodity Index, which was one of the first most popular indexes. I prefer this index relative to the Goldman Sachs index because the Goldman Sachs index is about 65% energy. But getting back to the point that I wanted to make, the Bloomberg Commodity Index closed in 2019 at 81, and we are just now getting back to 81 in the Bloomberg Commodity Index. So that's weighted across 23 different markets. And so, yes, there's been a tremendous commodity rally over the last 6, 7, 8 months. But in point of fact, we're just now rallying the index into not only the trend line resistance, but also that congestion and sideways movement that really was in place between about 2016 through 2019. So that's something that I've got my eye on this coming year.
And to really get this index going, I mean, you're going to need to see other things aside from the grains post some phenomenal returns. I mean, you need to see the energies. You need to see crude oil break out above. We're into some multi-month highs, but I mean, you need to see crude at $70 or $80. You need to see the metals appreciate even more. Livestock would help, as you mentioned. Do they have softs? Some of the soft commodities in the Bloomberg?
I think cotton. They do. Oh yeah, cotton, sugar, coffee. All the major softs are in there. To some weight.
So grand scheme of things, commodity markets, and this chart goes back to 2008. We're still pretty darn cheap here, really.
That's right. But you have to talk about 2008 in terms of where crude oil prices were.
Right.
Crude oil went from about $100 in March of 2008 to $145 in June and July, where it peaked out. Corn prices were $7.50. I mean, the U.S. was building ethanol capacity as quickly as they could spend the money. Mm-hmm. And so, oil and corn prices were basically tracking each other in 2008. And I just want to say a word. I'm not trying to plug my newsletter, but I think.
No, you should. Go ahead and plug it.
I think to put in context about my view about commodities for the coming year, my first edition of my newsletter every year on the first or second day of January is I make fearless forecasts. And one of my fearless forecasts this year is I have 5 categories. And one of the categories is the underachiever of the year, where I've said the Bloomberg Commodity Index will be the underachiever of the year. In other words, to put it in short terms, I think we're going to stall out the commodity index not too much further higher than where we are now. And so if you look at that chart again, I expect we're going to see some sideways movement now that we've rallied into that congestion area.
Yeah, and I suppose that's a possibility. And do you think that a lot of that hinges on what the dollar does? I mean, is that, like you said, the perception of a weaker dollar could inspire more buying, but maybe not if the dollar decides to hold together?
The dollar is going to be, I think, from this point forward, a function of what interest rates do. Mm-hmm. And today's signal suggests that interest rates have become a bigger concern. Now, obviously, I don't expect the Fed to go to anything except an easy money policy, but interest rates on the 10-year at 1% is still quite cheap relative to inflation that's already at 1.38%. And so there's room for interest rates to move up. If interest rates move up, so the dollar will at least stabilize, if not strengthen a little bit from here. But my real view on the commodity index is that I think oil will average, I've said this, I think oil will average no better than $52 in 2021. Mm-hmm. The reason for that is OPEC has made it quite clear that they're going to keep oil prices in check such that they're not going to allow the U.S. oil producers to take share from them again.
Okay, I want to go to this this chart of the CFTC fund positions.
Yeah,
that's the name of the game here, and that's what we're talking about. And this chart I'm going to show up on the screen here is actually kind of shocking when you look at it at first glance, and we're going to try to explain it. The chart I'm going to throw up here is the combined net fund position, and this is the futures only version for you CFTC nerds out there. But the combined net fund position across the corn, soybean, SRW wheat, meal, and oil markets. And it, at yesterday's close, if you follow the estimates that the private groups and the newswires put out, it was record large and by a fairly wide margin, 863,000 contracts across those 5 markets. This is some phenomenal stuff, Ken.
It is a phenomenal thing, and it's essentially gotten there over the past week. We've had, you're ticking up at levels 200,000 contracts, basically not 200,000 contracts on a futures basis, but 150,000 contracts above the most long position ever held by the managed money funds. And so I'm going to be first of all, I'm not convinced that the estimates of the fund positions are correct. If I look at open interest changes over the last 5 days relative to where the last CFTC positions were.
It's not gospel, those
it's not gospel, but they can be wrong by a lot, and still we're going to have record fund positions. And so I'll accept the notion that we're going to have a record fund position when it's announced on Friday. So I'm going to be very interested to see the market reaction to this. It may mean nothing, but I think, as your chart clearly shows, anytime we've gotten into the levels of about 700,000 contracts net long in these markets, we've seen corrections for one reason or another. And so the higher prices go, the more risk positions grow, the more vulnerable the market is to anything other than bullish news. So I think we're in a very vulnerable situation here. I'm not saying we can't go higher, but I'm just saying the higher the fund exposure goes and the higher prices go, it's priced for perfection, I think, at this point.
So I think that the $1 million question for a lot of people is, looking at this chart, these large speculators, fund money, institutional money, they hold this enormous long position. Is this all because of supply and demand? Is it because of inflation fears? Is it because of a weak dollar, or is it a combination of all of the above and maybe some other things?
I think it's a combination of the above, and I think the proportion of the order is exactly the way you named them. I think there is fear, whether it's justified or not, we don't know yet, but there is certainly fear of continued weather issues to constrain the crops, not only in South America currently, but you look at these U.S. drought maps, and certainly I'm sure potential for a severe drought is in the backs of people's mind, and should be. I think so.
Yeah, it's not too early to talk about that, and I don't want to make this into a weather conversation at all, but we've seen this drought in the U.S. push from west to east for months now, and there's not a whole lot of relief, and it's making its way into the backyard of some of these row crop producers in the Dakotas and Iowa, Western Corn Belt. It's cause for concern. It's probably not too early to be concerned about that. So you have that. I understand that. How much of this do you think is institutional money coming in and saying, we're going to buy commodities as a hedge against inflation?
I mentioned early on the markets of 2008, and there's been a change in the way investors have gotten exposure to commodity markets since 2008. If I combine the swaps positions, which basically is the money that's going into these commodity indexes, or at least it was back in 2008, and still is. If I combine the swaps index positions with the managed money fund positions, even the last, as of the estimates that you just put up, we're about 100,000 contracts above the all-time high in 2008. Of the combined swaps and fund positions. Mm-hmm. Now, I think that's a good way to look at it, because what I've seen happen over the recent years is that rather than investors committing money for 2 or 3 years to these swaps positions, I think they are now pouring the money into managed money funds. And so I think the totality of money that's chasing commodities is not significantly higher than it was in 2008, but the form that it's being chased with is different than it was in 2008. And the distinction I would make is, again, swap money that goes into swaps positions are typically 2 or 3 year commitments. And I think what the investors have said is, look, commodities trend changes too frequently for me to be committed 2 or 3 years. And by the way, when supplies get surplus, I'm rolling lower price commodities into higher price futures, right? Mm-hmm. And so I think investors over the years have gotten smarter. And so now they're putting their money into managed money funds where they can almost pull their money at will anytime they want to. So I just think there's more flexibility, but the amount of total risk committed to commodities, I think I would draw the conclusion that it's not materially higher than it was in 2008 when you had $7.50 corn and $145 oil.
Okay, so speaking of that, and I know that this is not going to throw you for a loop at all, but I want to pull up a corn chart that goes back to that 2007, 2008 timeframe. And I want you to argue or tell me if I'm crazy for thinking this. I have thought that there are perhaps some parallels between that timeframe and what's just happened currently. In 2008, 2007, we had a financial crisis. We had government stimulus. we had a weak dollar, a much weaker dollar than we have now. But there's a lot of parallels there, and you had a bunch of speculative money pour into these markets. And I'm going to put this corn chart on the screen. And of course, our viewers here and listeners, a lot of corn and soybean growers. But this is corn from, what I have circled here is that 2007 through like 2009 timeframe. Explain to me what happened in that timeframe.
Well, the rally in corn and beans actually got started in about September of 2007. And I'm not going to go back and try to reconstruct all the fundamentals that were occurring during that time. But, we talk about $145 oil. Well, the oil rally didn't really get started until early in 2008. And so we were driving crop prices higher. And then kind of the oil was, we were talking peak oil. So that was certainly driving oil prices higher. But then, the money peaked in about late February, actually, of 2008, in terms of the money exposed to commodity prices. And the indexes as a whole didn't really peak until about June or July, when oil peaked. And so, then along came, by certainly midsummer, we were seeing some problems develop in the financial markets with mortgage-backed securities, et cetera, et cetera. September of 2008, of course, was the Lehman bankruptcy. And so, now the rest of the story. And so, we saw $7.50 corn in June of 2008. And by the end of December, the nearby futures were trading at $2.90. And money was just pouring out of commodities in all fashions from about June forward into late 2008. So
is the lesson here to some extent that this big managed money that we've talked about, it can leave just as quickly as it came, or perhaps even faster?
It will leave faster than it came in. That's typically always the way it happens. I have another chart. I didn't want to, we didn't want to create information overload, but I have another chart that I looked at the peak long position in managed money funds going back to 2007. And of the 12 peaks in managed money fund positions in the 5 commodities that you've listed, 7 of those 12 times saw a 20% decline in the fund position within 2 weeks.
That happened a lot. And here I've got that chart on my screen from 2007, 2008. And the position from that time frame really pales in comparison. It's half of what it is today.
And the other thing I would mention that's different about this current level of risk positions in the funds, what's different about this year is that there was a peak in the net fund long on October 27th, but there was never a 20% correction in the size of the funds. It never got to a 20% correction.
There's been very little correction at all. I think
the most correction was about 18% on the 6th week, if I recall.
We had this
never, and so never in the history of those 12 peak fund positions, never until this year had we not at least had a 20% pairing of risk positions sometime between 2 weeks and 7 weeks. Never happened this year. So that is certainly, we can justifiably say this time it was different. So
it looks like we went from mid-August all the way through first week in November without the funds peeling back their position across these 5 commodities, which, like you said, is just some phenomenal stuff.
It really is. So we do have to recognize, the tolerance for risk has been sticky this time for sure.
So as we move forward here, keep in mind the vast majority of people listening and watching are farmers. They have downside risk in these markets. What I always tell people is that, a correction is probably inevitable. Picking the time and picking the price from which the correction occurs, that's the difficult part, right?
There's not a person among us, I don't think, that ever desires to hit the top. And
oh no, there are a lot of people who only want to sell at the top.
yeah.
They can't, but they want to.
But I looked, for example, I looked this morning for the first time ever this year, looking forward for 2021 crop prices. I looked at what returns over variable expenses are for corn and soybeans. And I have two different models. One uses national average yields for corn and beans, and one uses a yield of 220 corn and about 65 bushel beans. Based on yesterday's close, I think we were $487 net revenue for corn and beans for the high yielder guys, and about $325 net revenue per acre over variable for the national average yield people. And so, what I guess the point that I'm trying to make is, don't try to pick the top, pick a level of return that you're satisfied with and make a commitment, have a plan. Even if you have a plan to have trailing stops with your forward contract counterparty or your futures broker, just have a plan, because there's one thing that's constant about commodity markets is the trends will change, and rarely does anybody see it coming. That's why they change. Nobody sees it coming.
That's very good stuff. Ken, it was really great having you on the show again. Is there any final thoughts here before we wrap it up?
No, I mean, we haven't talked about next week's USDA report, and I guess it's probably heresy to even suggest that we might see an increase in corn production or an increase in bean production. That would be heresy to even mention that that's a possibility. But
how dare you come on my show and say that?
but you have to, every day as a risk taker, you have to ask yourself the question, what might change? And whether it's probable, I don't know. But it could be low probability, but high impact. So you just have to ask yourself, what might change? And right now we've got sentiment at 90% plus bullish across the board in these 5 markets that we've discussed. And you just have to be alert to any possible change. The risk that's on the bets that are made just leave themselves to a lot of vulnerability.
Hey, Ken, thank you again. Remember, everybody, if you are watching on either YouTube or Facebook, hit the like button. Make sure you subscribe to Grain Markets and Other Stuff on your podcast app or on YouTube in particular. If you have any comments or questions, drop them in the comments on YouTube or Facebook, or you can email me at info@standardgrain.com. Again, I have the links to the Morrison on the Markets website on both platforms. So if you need some info from Ken, make sure you get a hold of him. We will talk to you guys a little bit later. Thank you for tuning in.